So what was that?
No, I was just going to say, let me get the button.
Okay. So I'm Katie Hammond. I run the Business Improvement District for downtown Troy. And we're here today to learn about credit best practices. Destiny, thank you for joining us this morning. We have a full presentation for you. And then afterwards, if you have any questions, feel free to put those in the chat. Or sorry, if you're in the conversation here, we can put those in the chat for now. And then if you are on Facebook and you want to add a question, feel free to put that in the comments. So thank you all for being here today. Destiny, do you want to tell us a little bit about yourself? And then we can jump right into the presentation.
Yeah, perfect. So I'm Destiny Watkins. I am the Small Business Lending Officer for the Community Loan Fund of the Capital Region, which is a nonprofit organization. We have our main office in Albany. We have a satellite office in Schenectady, and we focus on community development. So doing free trainings and technical assistance for people that want to start businesses and that are looking for some help with business plans, cash flow projections, all that sort of thing. And then we also have a small business lending program where we focus on making loans to low-income owned, minority-owned, and women-owned businesses for startups and businesses that have been in business for a year or more to help them, create their own wealth and start their own businesses. I've been with the organization for about 5 years, 1.5 of which was on our training and technical assistance side. I've been the lending officer for about 3.5 years, working with folks to help them get financing for their small businesses.
Thank you.
Yeah, so just to kind of jump right in, I'm going to go over kind of the basics of credit and just some general things that most people may or may not know about credit and how a lender would view your credit potentially. Most small business loans require a personal guarantee or some sort of personal credit check. So I'll kind of go through those things, touch on a little bit of tips on how to improve your credit and things that you may want to start doing to also build up credit. And then we'll go into questions. And that way I can get a bit more specific about what people are looking for. So just the credit basics. Sorry, this bar is somehow all the way over here. I apologize. The buttons are all the same. So credit is basically just the ability to borrow money or access goods with the understanding that you'll pay later, which everybody kind of understands about credit. It makes it possible for you to purchase things that may potentially be too expensive, particularly in a business standpoint of, expensive equipment and things like that, that you may need to finance or that you don't have the money for right up front. And it makes more sense for your cash flow to potentially borrow that amount. Working to improve your credit will also help ensure that you are able to qualify for those loans or that potential financing arrangement for equipment or other purchases that you may need when you're starting up a business. And it's also pretty important to kind of have access to credit, particularly in an emergency situation. You never know what can happen in a business if a big piece of equipment, fails or your HVAC system goes, do you have funds that are available to help you with those situations? So that's kind of how I look at, why credit is important. So what makes up your credit score? This is kind of what people look for. This is what I take a look at when I'm looking at credit reports. So about 35% of what makes up your credit score is your payment history. So on-time payments, do you have delinquencies? Are you missing payments? Do you miss a lot of payments? Those are really the things that drive your score, and they have a lot of weight as far as what your credit score actually is and how lenders will look at you. Your credit helps us know how good you are at paying off your debt. So if you have a lot of missed payments or late payments and things like that, that may affect, how we view you as a potential borrower. You also want to take a look at your capacity, and that's the percentage of available credit that you have. It also ties into what we call your credit utilization score, which is the amount of credit that you're using versus the amount of credit that you have available. And you want that to be under 30%. So you never want to use more than 30% of the credit that you have available, because that can really change your score. You also want to look at, your accumulation of debt. How much debt have you had in the last 12 to 18 months? Are you a person that's consistently looking, consistently opening credit cards? It may not seem like it does affect you, but when when a lender is looking at your credit score, we kind of take a look at that, like how many other debtors do you have? Where is your money going, type of thing. So that helps us see, you know, how much funds do you have available to potentially pay back a loan that you might take out with us. We also take a look at your mix of credit, and that does affect your score as well. Not as highly as everything else, but you know, some credit accounts actually count for more. So if you have like a mortgage or anything like that, obviously that's a big dollar amount, but it's also a longer credit loan because you're paying that mortgage over 15, 30 years. So we take a really good look at how you've been repaying that. A credit card that you would get, you know, like a company card or a TJ Maxx card or anything like that, that does count as well too, but it's more of a quick turnaround type of loan because you would be paying that down way quicker than you would like a mortgage or a car loan. We also take a look at the length of your credit history. So how long have you had credit? That also really does affect things because if you've only had, you know, one credit card for 6 months, we really don't know how good you are at paying back debt because you don't have like a kind of longer time frame that you've been paying. Typically, you want those things to be about a year, and that kind of gives you a little bit of a history that we can kind of go off of. A year is usually, you know, kind of best practices for new things. And obviously, the longer that you have your credit, the better. So this is just a little bit of an image of what may potentially come up on a credit report. This is 3 credit reports in one with the 3 credit bureaus, Experian, TransUnion, and Equifax. This shows kind of the different ways that each credit bureau may show information. And it just goes through in the middle of it where you see the green, the red, and the black is kind of what we see when we look at repayment history. So obviously the green payments are on time, the red would be about 30 days late, and the black may be an account that's closed, or it may be 60 days and things like that. And so that's kind of what we look at is when were late payments, how long ago, were they recent? And that kind of makes all the difference as far as everything. So this is just a little bit about what I talked about your credit utilization as far as, you know, having X amount of credit and using a certain amount. On the left side, you'll see that that credit utilization score is 51%, with available credit of 18,000 and the total credit of 33. So that equation is broken down and gives them a 51% utilization, which also affects, you know, their overall score. So if you can bring that utilization down, it will actually increase your score because it means you're lowering your total debt. And the right side, obviously their score is, their utilization rate is about 6% based on, you know, what they have available and what they're using. So just to get into financing a business venture, I know a lot of people are looking to potentially get financing for their business or have questions about, you know, how does credit impact those things? And here's just some tips. So not every business needs a loan. And this is some of the things that I kind of talk through with clients all the time. So you want to look at all your available options before you decide if a loan is right for you. There's different ways to kind of make things happen for a business. You also want to you don't want to take on debt that makes you uncomfortable. So if you really can't wrap your head around taking a loan, or you don't see the need for a loan, odds are that you may not need one, or you may just be uncomfortable and you need to change your business plan about how you're going to make things happen for your business. If you get a loan, you want to make sure you understand all the terms and interest rates. You want to identify reputable lenders. So there are tons of lending options out there, but it's really up to you to kind of do your research and ask questions so you make sure that whatever deal you're getting involved in actually works for you and the business, that the terms are okay, that you're going to have a long enough repayment period, that the interest rates aren't going to kill you as far as payments and things like that. You also want to make sure you understand your financials before you apply for a loan. The closer to the actual amount that you can get, so exactly how much your business needs plus a little contingency. So let's say if you were looking to get a loan for a $50,000 piece of equipment, You should do your research about how much does shipping and handling cost? How much will it take to install the equipment and all of that? And that should be your number that you would apply for. And then figure out potentially what the effect is going to be on your business as far as revenue if that equipment is needed to kind of make your business finish working. So let's say it takes a month to get the equipment running to full capacity. You may want to include a month's worth of operating expenses to the amount that the equipment is going to cost and ask for a loan for that, because you realize your business isn't going to bounce back right away until you get that equipment up and running. So that's kind of like some of the things that I talk through with my borrowers, and figuring out, what do they need and how is that going to impact their business going forward? Because that also affects how you're going to be able to repay the loan. You also want to make sure that you have money to invest. Nobody likes to do 100% financing for a business. Not that it never happens, but it is a lot harder, as opposed to you coming to me and saying, hey, I have $5,000 and I need 10 from you, and that'll help my project. So you really want to have something to kind of put forward. And it also, helps the lender feel a little bit more secure that you have something, at risk as well. And that will just help you when you're working to try and get financing, because you come a little bit more prepared as far as an application goes. And the best time to borrow is before you start your project, not when your money runs out. So it's very important to try and, rope in a lender or explore your lending options when you know that you're going to need something. Like I said, not that it's impossible to get things, when you find a deficit in your project, but it's 1,000 times better if you kind of come to us and we discuss it before you spend the money and things like that. So what are the options for financing? And I know this is kind of, basic, but I think it's good to kind of go over, because it does also tie into, your potential credit score and how this may affect your credit. So obviously you can bootstrap, reinvest money that you earn from the business. You could have, savings and things like that. There's also loans from friends or family members. There's business credit, which can be viewed in different ways. I think a lot of people see credit in one traditional way. But that also could just be a bartering system where you're exchanging goods and services. That can also be a type of credit. Or potentially if you have an agreement with your suppliers that, you're going to get the supplies and you're going to pay in 30 or 60 days, that's a form of business credit as well. We also have, traditional loans from a regular banking institution, or there's SBA secured loans, which would, be backed by the SBA. They would provide a guarantee, which helps. Some banks do a little bit more riskier projects, or projects where maybe they don't have enough collateral. There's also alternative business loans from organizations such as the Community Loan Fund, where we take a little bit of a different look at how to finance businesses. We focus a lot more on business plan, cash flow projections. There is a credit portion, but we're a lot more flexible. And there's some grants out there sometimes for small businesses as well that you may be able to take advantage of. So if you decided that you need a loan, here's just kind of the things that you should do and that you should know about as you are pursuing a loan. So first of all, you should know your credit score and take care of any issues that may be on there ahead of time. You can always check your credit score on annualcreditreport.com to kind of pull that credit report and take a look at it. That way, if you know there's something on there, you should put in some time to take care of those before you approach a lender, because odds are they're going to find out about it. And that may be a stopping point and may waste time from you being able to actually secure financing. You also want to figure out how much you have, how much you're going to put into the project, and what you might need to borrow. You don't want to borrow more than you need to. You kind of have to find that exact number, because that also will affect your ability to repay and how long you actually have that loan hanging over you. You want to start a relationship with a banking institution. So figure out, which banks have better terms and things like that, which ones are more lenient with small businesses and who you can work with. Somebody that has like a local branch that you can go into and talk to someone if that's the type of relationship that you're looking for. And it's much easier to kind of approach an institution that you already bank at. You want to look at all your options for the best rates and terms. You want to be responsive and honest, and be aware of the timeframes for loan processing. That's like the first question that you really should ask if you have a project that's that has a time frame or a deadline and things like that, you really want to understand how long could a potential decision take. That way, you know, if you may need to go to a different lender or if you may need to hold off on your plans a little bit. So that way things can kind of line up. And then you want to solidify financing before you sign any leases or contracts, particularly if you need a loan to secure those things. So if part of your loan is going to be to acquire a space, you shouldn't sign the lease before you get the loan, because you never know what can kind of happen, and you don't want to be tied into a lease that then you need to break or pay to get out of with money that you don't have. And I touched on this a lot, and I'm just going to come back to it because this also can affect your credit, is how much should you borrow? So you really want to calculate it in the context of your profit. How much does your business make? How much are you already expending out? And then how much extra money do you have to potentially take on another debt? Don't take more than you can afford. And a lot of that has to do with, if you owe a loan and you miss a payment, that's going to affect your credit score, which will then affect you going forward trying to get other available financing or potentially refinancing the debt that you already have. So the amount is very particular, and you also want to figure out, what does your project call for? So just because a bank can potentially only do, you know, $20,000 and your project's really 50, you shouldn't just kind of take the 20 and think that you'll figure it out later. So maybe approaching that bank or your lending officer, you can tell them, you know, this is really the dollar amount I need. Is there any partners that we could bring into this? Can we do this? Or you can figure out a way to scale back your project in a way that makes sense so that you can actually use that 20,000. But you don't want to kind of just take the first offer if it doesn't match what you're trying to do. And this is a good way to figure out, you know, financing options. When you approach a lender, we do this a lot with clients to kind of figure out exactly what they're going to use a loan for and if the dollar amount that they're asking for makes sense. So this is what we call a sources and uses chart. At the top, we have, you know, the owner's investment, which would be whatever you're going to put in, and then potentially our loan and what we're going to have. And then at the bottom, we have kind of all the uses that the person would break down about what they're going to use the loan for. And that would be, you know, through your own research of figuring out how much do these things cost, and then how much working capital, as you'll see the last line before total, do you need to kind of make things work until your business can operate at full capacity according to your business plan. And this is a great thing to throw into your business plan. And you can also plan, you know, asking for the loan into your business plan, depending on how your business is going to operate and how your credit looks. And this is just a little bit about cash flow projections that a lender might ask for. And this just ties once again into the loan amount and your credit expectations of how much you may qualify for through a loan. And if you haven't ever done cash flow projections and you're looking to potentially get a loan, I would highly suggest that you do these. You can also, you know, talk to me later on or afterwards. We have some templates and things available to help people put these together. But this is kind of a breakdown of expected revenue. So when I talk to a client about, you know, the loan amount that they may be looking for, we base a lot of that on cash flow projections. And it would be this similar thing where, how much do you anticipate coming into the business? How much sales do you anticipate, you know, each month for the next year? And based on that, can you afford, you know, loan payments and things like that? And if you can't, that may be the point at which you either take a look at your business plan again, or kind of change the amount that you may be looking for and what you're going to do with it. And some of this can also help you plan if you're going to reinvest profits back into the business, because you'll have an expectation of what's going to come in, and then at the bottom, you'll have your anticipated expenses. So this shows all the things that your business has to pay on a monthly basis based on the income that you're making. And also you should include, you know, how much you may potentially pay yourself or need to pay yourself to cover your own personal debt. So a lot of lenders will look at, you know, number one, what you're asking for, what your credit score is, as far as, you know, how much credit do you already have out, how much debt, what your payments are, what is your business expecting to come in, what debt does the business already have, and then they kind of make an assumption and an equation based on that. So all of your expenses kind of tie into each other. So business expenses, personal expenses, and any other outside debt that you may personally have. And then they make a decision on if you can afford the debt and how, things will work based on that. And this is just kind of a quick little scope of a shortened profit and loss that someone may do to present to a lender or even part of their general business plan. So how do we evaluate loan requests? And a lot of this is going to be from my perspective. The Community Loan Fund does do things a little bit different from what you may find at a traditional bank or a credit union. So it really does depend on the financial institution that you're working with. Different lenders have different processes, different documents that they may need for loan underwriting. Typically, it's the business plan, 1 to 3 years of cash flow projection. So the first year should be by month. The other 2 years could be quarterly. Your credit report, which we will pull, and that helps us figure out, like I said, your repayment history typically for debt, what you may have on there. We do take a look at any issues that may be on there. So you don't want to have any collections or other things that you haven't paid, because that's a red flag. Your current profit and loss statement. So that would be from the beginning of the year to current, depending on when you're applying. And we use that to see what the business has pulled in recently and what expenses the business has had and how the business has performed. Has it generated a profit or has it been a loss? And then we kind of ask questions based on that. We also want to see your last 3 years of personal or business tax returns, if you have those. Your business formation paperwork, obviously, to kind of show that you are a business, and because this would be a commercial loan, that's what we'd be looking for. And that's the name that we would use on the paperwork and everything like that. We also want to see a copy of your driver's license, your resume, which kind of shows any experience that you've had in that. And that's super important for startups, is as much as you can pull together to show that this is a great project and this is how I plan to generate revenue, this is how I plan to repay the loan. That's kind of what we look for. And a description of available collateral and what you may be putting up for the lender as a way to potentially access the financing. This is just really a quick image of a business plan. I figured I'd put this in there since I do talk about business plans a lot. This is what lenders look for. There's a written section, which are all the logistics and the basics of your business, like how are things going to run? And I really have to understand that so that I know potentially when your busy season may be, what sort of sales are you going to do? Does it make sense for the industry you're in? And then there's also the financial data, as I mentioned before, where we look at, the sources and uses. What are you going to use the loan for? Your cash flow projections, and then, your supporting documents, which would be listed on whatever loan application you're filling out. So as far as credit evaluation, and I'm going to take a little bit of a step back as I talked about how we look at, the total application. This is particularly what most lenders look for in credit. A lot of times, some lenders have a specific credit score or credit guidelines that you need to have. The Community Loan Fund doesn't necessarily have a particular score. We do require that your credit's in good standing, but that can look various different ways for everybody. Everybody's credit report is just a little bit different. Typically, people look for mid to high 600s through the 700s, and obviously anything better than that is very great. All lenders want to see that your credit is in good standing. So no late payments, recent bankruptcies, judgments, liens, repossessions, or collections. Those sort of things can be a stopping point in an application. So you really need to be current with any debt obligations that you have. Or if there are issues, you should talk those through with your lender and see if things can still proceed. But if you know that there's something open or pending on your credit, you should either try to get on a payment plan or settle it or work on that. You could even, access a credit repair company or something like that to work on those things before you apply for credit. A solid credit history is also what we're looking for. So no repetitive missed or late payments, accounts that have been open for at least a year, which there's some wiggle room there. But, like I said, a year is really a good kind of time frame to see how well you repay debt. and a good debt to income ratio. Some lenders do look at that, and that's just your total debt obligations versus the monthly payments in comparison. And that's how they kind of decide if your budget may be too tight to support extra loan payments. You don't want to be overextended. And that's kind of a lender's worst fear as well, is that somehow you may not be able to repay, our loan because you have all these other things going on. Not to say that you couldn't get approved, but that's just some of the things that kind of goes into account when we make lending decisions. These are just some red flags. If you do see any of these things on your credit report, this is a point where you would want to get that taken care of. This in particular is a judgment that is on this, examples credit report, and it gives us the information and things like that. If you pull your credit report on annualcreditreport.com, it will tell you, when certain things are supposed to fall off and when certain things got reported. But this is something that a lender may see if you have a judgment and it's not settled, or if it was filed. And sometimes people may not know that these things have been filed. So it's always important to keep an eye on your credit report. This is just another one. In this particular case, it's a collection, which shows up, and it kind of shows the amount and what the account was for and what the repayment was for and what's owed. And so these are just some tips for best credit practices that I suggest if you're looking to either maintain good credit or start to generate some more credit. Like I said, check your credit on a regular basis. There's lots of apps and websites available. Most people use Credit Karma or Credit Sesame. A lot of the credit card companies also have it, like Discover does a free FICO score. Capital One does CreditWise. So there's some options available where you could daily check it, and it wouldn't affect your credit score because it's you doing a soft inquiry on your credit, as opposed to a lender pulling it, which will affect it and cost you points. So also each year you receive one free credit report from each credit bureau, and you can pull those at annualcreditreport.com. And if you're, doing some sort of credit repair and things like that, I usually recommend spacing it out, maybe pull one every 3 months or 6 months or something like that. That way you can keep track of any credit repair that you've done and see how it's affecting your score. You also want to pay your balances in full each month to prevent unnecessary credit charges. If you're not able to, at least pay it on time. So 100% on-time repayment history is the number one thing that impacts your score. And number two is keep your utilization rate under 30% if you can, because that also is a big factor of your score as well. Take care of any collections or other blemishes, and dispute items that don't belong. If you check your credit report and there's some things on there that you don't know how they got there, or you don't know what it is, you should always call and see. Sometimes things get falsely reported, or things get reported prematurely, and maybe you had taken care of it. So make sure you do check that, and if it's wrong, get it taken off, because that's important, and that can also help your credit score. And if necessary, you can work with a credit repair agency or some other organization that is helping individuals with credit repair or home ownership. Sometimes they'll have credit counselors and things like that, particularly if you're looking to buy a home. And I always suggest this, and I know it's weird to put this in a credit presentation, but building a team is super important, especially for business owners. You can't be everything to your business. And a lot of times, we have weaknesses, and we really need to identify what our weaknesses and strengths are as business owners, so we know when it's applicable to pull in other people to handle things. And I added this because this can also pose credit risk for you and your business. You need some key professionals that I always recommend. A lawyer, if you're doing, potentially a complicated business formation, or you have contracts and things that you have clients sign, you should always get them looked at by a lawyer. We participate with free legal clinics, and we have dates throughout the year and things like that where you can get a free half an hour with legal counsel, and I can make that available, or you can contact me, and when we have dates come up, I can share those as well. An accountant to help you with your taxes, a bookkeeper for everyday accounting, payroll services, potentially if you have employees and need to do withholding and other and workers' comp and different things like that. A manager, if you don't have business experience, sometimes, you're the person that does the services, and we get so tied into, doing things that we may not take that step back and do the administrative stuff. And a lot of that could potentially pose credit risk if those things are done wrong. You know, if you misfile your taxes and owe money, you may get a tax lien. If you know, have a wrong contract, you may be in breach of contract and owe, you know, fees that were paid to you, you may owe them back. And that may be something that winds up on your credit if, you know, you don't have the money available to pay it right away, or if it's never taken care of or you forget about it. So a lot of these things can eventually cause you credit concerns down the line if they aren't done correctly in the beginning. And that's why I mentioned it. And then if you need help creating any of these documents or a business plan, or you just want to kind of chat, the Community Loan Fund can help. We do free email or phone consultations due to social distancing right now. Paul Stewart is our Director of Training and Technical Assistance, and you can always give him a call or send him an email at paul@mycommunityloanfund.org. And if you have, you know, lending inquiries or just kind of want to talk and hear things from the perspective of, you know, a lender, you can always send me an email as well at Destiny, DESTINY, at mycommunityloanfund.org. And we also have a new training platform online on our website, which we are working on getting more information up there, mini courses with some videos, some handouts and things like that that you can check out as well that may be helpful for folks. Thank you.
Thank you, Destiny. Feel free to leave that up, actually, if that way people can write down any information they want to collect here pretty quickly. So we had a couple of questions that popped up. Let me just grab them here. Where's our chat? So Cherise says, you had mentioned we should secure a loan before we immediately need it. How long is a typical loan offer and deadline for accepting?
So that may depend on your lender. Typically, they may give you about 30 to 60 days for a commitment to be good. I only mentioned it, and I think Cherie was interested in real estate. Is that correct?
Yes, real estate.
Yes. So in your case, you may potentially have already looked at properties and have a pretty good idea of what you might want to purchase. So I think once you got that or had a list of prospective properties and the potential contract amount, I would say that would be a good time to approach. So that way you know your dollar amount, but you also haven't signed the contract yet, maybe. But typically it's 30 to 60 days depending on lender.
Great, thank you. And Destiny, did you say your email address is destiny@mycommunitylending.org?
mycommunityloanfund.org. I wonder if I can
loanfund.org. Thank you.
back screen. Yeah.
You can click back on it.
Yeah.
And feel free to add that to the chat too. Are there any other questions that people have? I'm not seeing anything on the Facebook right now, but if you're watching through Facebook, feel free to write any of those questions in the comments. And any other questions from anybody who's on the call today, feel free to let us know right now.
Question. So your personal credit is very important to getting a loan for the business credit. So I have like business credit cards as well as my regular credit cards.
Mm-hmm.
Are both of those combined and considered part of the consideration when you're checking?
So for certain organizations, they may take a look at business credit. Business credit is reported to the Business Credit Bureau, so you won't see it on your regular traditional report and you won't be able to access the report for free. So you would actually have to search for that and get a report of your business credit to find your business credit score. Most lenders, particularly for startups or new businesses, will look at your personal credit in order to make a lending decision.
Okay, so they're not going to bother checking for the business credit score.
Not unless you have it or it's been discussed and they've asked about it. And that's lender specific. For our organization, we take a look at personal credit in our decisions. And we do a lot more with startups and things like that. And I know I said I would mention some tips about getting business credit started. So it's great that you have business credit cards. And that's a good way to get things kind of jump started. But as I said, business credit can also be used in different ways, such as direct relationships with your suppliers, where maybe you have 30, 60-day terms where, you know, you would get inventory in and maybe pay it in 30 days. So you'd have a credit account with your supplier. That's one way that you can do things. And you can also, so you should open a business bank account in the business's name if you haven't already, and
Right.
work on maybe getting a small, loan through that. And that should be able to report back and build up your business credit some. So the main question to ask when you're going to a lender is, what sort of credit do they look at? And if this is going to be something that will report for your business credit report.
Okay.
And there were some questions about protecting your personal credit. Do you mind speaking about that?
Yeah, so I think a lot of that is about the personal and business separation, which you find a lot more with the formation, particularly of the business that you do. So if you are a sole proprietorship or a DBA, you don't really have that separation of your personal assets from your business because of the type of formation. If you're an LLC, for example, you get a little bit more of that corporate veil protection as far as keeping, assets of the business separate from your own personal in case of any issues. And that is only really secure if you keep everything separated. So if you don't intermingle funds with your personal and your business and have it all in the same account and stuff like that. So that's where you get the separation, is through your formation of your business and how many things you have in the business's name and as a business asset, as opposed to your own personal name. And it's hard to really separate your personal credit from your business until you start to generate a solid business credit score.
Another question.
Yep.
So if I were to say purchase some commercial property, would I have to purchase that under my personal name and then switch it over to the business name?
If it's a commercial loan, it should still be able to be done through your business. The name that you use that owns the corporation will depend on how that will work for you. So there's some different tax implications. So this is where potentially consulting a lawyer and an accountant before you get the loan for the property would be helpful, because you may want to own it personally for different reasons. Some people do own, their commercial properties personally and have the business rent it for those purposes. And like I said, it's really lender specific of if they will allow you to do that. But on the commercial space, typically those things are done through the business as a corporate, as the business entity. Even our loans are in the business's name. How they wrap you in as an individual is they have you sign a personal guarantee, which basically states, if the business doesn't pay it back, I agree to.
Okay.
I hope that answered it a little bit.
Yeah.
There were questions before about the large banks versus credit unions. Do you mind speaking on that?
Yeah, I think with any organization, it really depends on how they do their lending, how they look at lending. A lot of the bigger institutions you'll find, they do a lot of kind of quick lending, like they have a particular application, they have a certain credit score that you need to have, and that's kind of how they make their decisions. They have, we can do X amount of dollars, we have this amount of collateral for this loan, you get a yes or a no. There's not really any super huge involvement. I think when you get down to the credit unions and smaller local banks, you get a little bit more of a relationship. You're able to walk in and you talk to a business relations manager, and you would have your accounts there at some place that you're comfortable banking. And typically they're a little bit more lenient for small businesses. I think their fees and their rates and things like that are a little bit more comfortable for small businesses. They kind of have a few different buckets that they kind of pull from when they do small business lending and things like that. Most banks won't lend to startups, which is where organizations like ours come in, and other alternative lenders such as a Capital Region Chamber or Capitalize Albany and the Community Loan Fund is where we help people kind of start up and grow their business to a point where they can then access better interest rates, better terms, and things like that at a regular credit union or a regular bank.
Do you mind speaking on the difference between like a line of credit versus a credit card versus just a credit with a bank?
Sure. So just to start with a credit card, and that depends. I know a lot of people were mentioning, talking about how they were starting to do their credit and get a secured card. which would be you putting your own money into the bank and using the card to kind of draw down on money that you've already put in the bank. And that's a good way to kind of get your credit started, because it's secure. It's a secured card that you're securing with your own money that you are borrowing off of and repaying. And that's a way to jumpstart your credit in a way that would then allow you to access an unsecured credit card, where you would have a balance on it that you would be able to utilize, and you make monthly payments on it. And that's kind of up to you on how, you utilize that and pay it back. And typically those have, higher interest rates on credit cards of, usually it's like 20 to 25% when you first get the card, and you can slowly, hopefully bring that down based on how long you have the card and how you take care of the debt on the card. And you can get credit limit increases and things like that, depending on how long you've had it and when you request those, as opposed to a line of credit with a bank, where the bank would hold on to the funds and you would be able to utilize that line of credit for certain aspects of your business. For lines of credit with us, they're project specific. So we have line of credit options that you could utilize for a particular contract or project that you have. So it would be based on when you would get paid from that project, you would pay back down the line of credit in full. Typically, lines of credit are interest only payments until you receive, the payment from wherever the source is that, you were doing the work for. With the bank, a line of credit is a little bit different, because they allow you to kind of pull on the line of credit at regular intervals. You don't necessarily need to provide, documentation of what you're using it for, but you do have to pay it down in full for at least 30 days each year, and in what they call a cleanup period. So a line of credit is kind of, cash available for any odds and ends that you may need, and they revolve. So as you pay it back, the money becomes available again for you to reuse for however long, the term is, typically 12 months that they'll allow you to use the line of credit. You pay it down. They'll look at how you used it, if it worked well, if you repaid it on time, and then they may extend it for, a longer term. And that's all different from term loans. So a traditional loan product that most people find, where we would, do a loan for equipment or for a building or anything like that, that would be termed out for a predetermined amount of time. So maybe 5 to 10 years at an agreed upon interest rate. And you would have regular payments, which would be interest and principal each and every month for that time frame. How's that?
Perfect. I just have had multiple people ask me questions about that in the past.
Okay, great.
Any other questions from people that are on the call with us right now? Feel free to unmute yourself. Okay. I was wondering if you could speak a little bit about, businesses that are existing that are kind of struggling with the current situation with coronavirus. Is there anything that they should be keeping in mind when, we did a survey of our Rensselaer County businesses, and about 25% of them didn't know how long they could last in this time. And of course, funding is a huge piece of that. And we also recognize that many of them have been pulling on their personal savings, their business savings, their lines of credit. And do you have any suggestions for anybody who's in that current position? And I know you guys have had some different loan programs and are looking to fund some of those as well, and some of the grant programs as well.
Yeah, so I think this is just a really crazy situation that businesses find themselves in. And this is unfortunately the factors of, what they have to do to help keep their businesses alive. And I think my main kind of suggestion would be to basically keep track of all the expenses that are part of the business with your credit. Because I think a lot of times what you get is, and I've experienced this as well too, with borrowers that may need to borrow money, but they've, funded some things on their personal credit cards and things like that. What they look for is, how much of this is business expenses? Can you tell me the dollar amount that may have been on your credit card that was to the business? I think a lot of this right now would be record keeping. And that way you can prove that this was a business expense and this is what I needed to do. And I think most lenders should be understanding about this, because it's the like I said, it's the reality of what small businesses have to do right now to kind of, cobble together and figure out a way to make things work, especially for businesses that aren't able to pivot and provide an additional service and bring in some sort of income, right now. I think going forward, businesses looking to reopen should take a look at their business plan and adjust it going forward. So if you're going to approach a lender for funds to reopen, it's obviously going to be kind of a hard push because most lenders are conservative. We're looking at, is this a business that can open and operate right now based on the new phases of reopening and things like that? So that will play a factor in any application. But do you have a solid plan for how, your business is going to weather this if you get this loan? Or is it just to repay, expenses and things like that? So we probably would do a look back period plus going forward, how are you going to generate revenue? And I think at this point, it's a good idea to kind of go back to that business plan and figure out some new ideas for operating in this new field now, because these things and, the safety protocols and things aren't necessarily going away, but you want to figure out how your business can adapt to that and what might be, the new way that you're going to operate. What are the safety protocols that you're going to have for your business? What phase is your business going to reopen in? And if possible, maybe some businesses weren't online before. Is there a way for you to have, an online sort of service, or is there a way for you to add something that may, help support your business going forward? It's really a tenuous situation, I think, particularly in the lending field, because a lot of us are looking at, can we get repayments from this? Is this going to be a good loan? And on my, my side of the table is I don't want to stack somebody with another loan when they're already in debt. So a lot of it is, am I adding an anchor to a weight that was already there? So just be aware of, what's been spent for your business and how much that dollar amount is. And if you are looking, to repay yourself or pay off debts that you accumulated during this time and are asking for a loan for that, how are you also going to help your own business going forward? Because that should be rolled into potentially what you're asking for. Because if you pay off, the last month's debt, what's to stop next month's from accumulating again too? So that's not really a solution. It's kind of just a Band-Aid.
Mm-hmm, definitely. I just had one more question and it's blank. It's now a blank. Anybody else on the call that has any questions for us? I was going to talk a little bit about, some of the existing loans, grant programs. The PPP loan, if you have not applied yet, is still available. There is still some money left in the pot. We also have a New York State-based grant program, which is coming out this week. So if you have not seen that, it's on downtowntroy.org right now. It should be coming out for applications or pre-applications today. And then the Community Loan Fund has a couple of different programs. Obviously, there's the loan programs, but there's also a grant. I believe that one is empty at this point, although you're looking to fund it additionally.
Yes.
So do you know any updates on that one currently?
I haven't gotten any updates just yet.
Okay, perfect. Well, when we have that information, we'll definitely send that out. And anything else that you're looking for, information that people have for today, and just to kind of finish this program off, anything you'd like people to know that wasn't covered today?
I think the only other thing I'd say is I'm definitely open to having conversations with people. I'm a big believer in looking at all the options on the table. And if, we aren't the right fit for people, we have, relationships, and always ask for a referral, even if someone can't help you. I think a lot of times people don't realize that kind of the lenders talk to each other. And if they can't help you, a good lender should be offering to connect you with somebody else so that you can continue your search for financing. And I think that's really it. And if anybody has any specific questions or, kind of want to talk in detail further with me, you can always shoot me an email and I'm willing to have those conversations.
Great, thank you.
Thank you.
And we have all this information will be all available at downtowntroy.org under our learning programs. And then we also have our coronavirus page. So if you're looking for resources specific to coronavirus, please check that out. That's at the red bar right at the top. So thank you so much, Destiny, for being here today. If anybody has any further questions, we'll send them your way. And I don't think you're on LinkedIn too much, but we do have the LinkedIn program that people can ask questions through, and we'll always send that over to you as well.
Okay.
Great. Well, thank you all so much for being here today. I appreciate you being here, Destiny, and answering those questions. We look forward to speaking with you in the future.
Thank you for having me. Thanks everybody for tuning in.
Have a good one.
You too.